Well, on the side chatter, either I'm boring or people have other things to do. So I guess they come to class, they don't come to class. The only thing I know is I don't pay their tuition. I also don't usually raise somebody grade just because they think I should. So it goes. 2 more lectures. Yay. Today, financial ratios. Wednesday, we'll be going with due diligence. Both of these are really a way to assess a business opportunity or prepare yourself to sell a business. When you look at financial ratios, it's also a way to compare businesses in an effort to decide what to invest in. Since you're asking in the chat, the lectures that are recorded on the modules section, you will see a link to a YouTube video. I would not claim to be internet famous, but there's some dude that follows us and I have no idea why he's not part of our class. And he just keeps going, thumbs up, good job, nice lecture. I guess if I needed that kind of reinforcement, I'd be happy. But it makes me wonder who on earth has the kind of time to look at random people's videos without any link to them. It could be a bot. So let's get into financial ratios and a little background on this. I've had a couple people over the years come in, make this presentation. The most recent of which was a chief financial officer for one of the local companies that manufacture molds for injection and blow molding called Tech Molds. And actually not a small company, probably $500+ million, a company that had gone through several acquisitions along their way, but local nonetheless. And when Mike was teaching this for me, he had a son in school and his daughter was in a different school, and he would often talk about their journey in school and what kind of prompted them. But for us, we're going to start out with his favorite way to start our lecture, which is, should I listen to this stuff? Why should I listen to this topic? And he was a firm believer that if you are into instant gratification, one of the clear reasons to listen to these materials is to do well on the final. For the whole semester, I would tell you that the material up through the second test was the other side of your engineering brain, not the analytic one, but the one that really probably makes you look at the managers and supervisors that are going to be around you, scratch your head going, what on earth were they thinking? It's the human resource side, it's the motivation side, it's the organization side. But now this last section of the course, we've been talking more numbers. Financial statements, business plans, costs, things that engineers can really sink their teeth into. And so instant gratification side, it's going to be important to understand the material here in order to do well on the final. As you can look back and see, we've spent 4 classes minimum, and probably more because we've talked about it during earlier sessions, that cover income statements, balance sheets, cash flow statements. Now we're going to put those into use in the way of financial ratios. So normally, when I present this material, the material that is in Canvas, I always want to say Blackboard, 11 and a half years of Blackboard. Well, the stuff that's in Canvas had no formula. It had a lot of blanks because I really wanted to give advantage to the people who were in lecture instead of the people who kind of would show up late, not learn the material. I didn't want it easy for them. I'm that kind of a jerk. So in this case, it was recommended that we write down the ratios, the equations. That's a little less important today because the material all online, it just makes better sense for this weird semester to have it available to you straight up. In terms of the long run, Mike would argue that if you are planning on or want to accumulate wealth, then these kinds of things will help you with your investment strategies. Most of the employers of technical staff, most people who hire engineers to work for them, expect them to have a knowledge of financial statements. So we did cover those, and you at least understand what they are and where the information comes from. But you really should not expect to walk into any company and not have to use that a little bit in your day-to-day. So they're expecting you to help them manage their business well with good engineering and good financial decisions. If you are interested in developing your own company, then this is also an important set of topics, especially if you're planning on starting it, building it, and continuing down the path until you sell it. Many entrepreneurs will start a business, get it running, show the opportunity, cash out of that one, and start the next one. Frequently, they will also sell most of their ownership, but not all of, so that if that business continues to do well, not only did they cash mostly out, but they would have recurring dividends and or an opportunity later when that business continues to grow to generate more wealth again. If you are managing your own money, you would be much better off understanding these ratios and make knowledgeable investments.
Could you please share your screen?
Oh, it's not shown?
No.
Oh, that's too bad. I can fix that. Thank you.
No problem.
That ought to confuse everybody, huh? So now, when it comes to managing your own money, making investment decisions, if you are going to be an active investor, then you need to compare one company to another to decide which one to use or which one to invest in. So for example, if you like the telecommunications industry, do you decide to invest in Samsung or do you decide to invest in Apple? Do you decide to invest in Sprint or do you decide to invest in Verizon? And the way you make those decisions, well, one way is to put them side by side, knowing that the nature of their business allows you to compare them. This will be a way to make more knowledgeable investment decisions. Otherwise, you end up basically rolling the dice, making a random bet. While that kind of infers that you would rather go to Las Vegas and make bets on horses or cards or dice. There are ways to make money that way, but equally good ways to lose it. And so making a good decision on investments based on your ability to analyze it is your goal. So we know the financial statements are using that accounting data to tell us how the business is performing. Remember that we are summarizing the net worth with a balance sheet. We are looking at the performance of the company with a profit and loss or an income statement. We're looking at liquidity of a company with cash flow statements to make sure that they are not running out of cash flow. But those are just the starting point of how to analyze a company. So we're looking at these three sets of documents that we've continued to refer back to, and we're going to use them to help us analyze a company. So a little bit of refresher perhaps. Our income statement will show us the sales or total revenue, the cost of goods sold or direct costs. Remember that different companies will use different terminology, but at the end of the day, they're all looking at the same thing. What money did we garner from our operations? How much did it cost us to do the direct portion, the actual goods or services portion? How much did it cost us to manage this business or house it in the selling general administrative? And then we start looking at different breakdowns, our net income, our earnings before interest and taxes. These are all subtly different views of the performance of a company. So when you see a company's earnings being described as EBIT, earnings before interest and taxes, or EBITDA, earnings before interest and taxes, depreciation and amortization, those are ways to look at how well a company is doing when they separate out those items. So what is the total income and then what is the net income? Taxes are going to be different from state to state, country to country. So earning before interest and taxes will allow you to compare, for example, company A in New York to company B in Arizona or company C in Australia, and bring that back down to how well are they doing before they have to happen to pay their taxes. It also takes into account whether this company has borrowed a lot of money to become what they are. And so you get to look at the earnings before any interest, because your interest, if you were to be running this company, might be different than theirs. So it's a good thing to know for example, how much cash is available to pay a loan you may take out. So these are key items in an income statement. When we look at a balance sheet, again, we were looking at the assets equals the liabilities plus owner equity. So the different items within a balance sheet that are of interest, cash and cash equivalents. So maybe you have cash and you have treasury bills, who knows, things that you can turn into cash. The money people owes you in the form of accounts receivable. In this case, they call it net receivables. The amount you have in inventory and the amount you have in other shorter term assets. Similarly, you have the long-term investments, long-term property, plant, equipment, etc. So some of the items that we will refer back to when doing ratios are coming from the balance sheet. Some of them are coming from the income statement. And the key is to understand what you need for each ratio and where to find it, knowing full well that every time you see a balance sheet, you probably will see two periods, last year and this year, so you can compare, are there any dramatic changes that have been going on? Frequently, you'll see the same idea on an income statement. Last year, we did $43 billion in sales. This year, we did $44 billion in sales. Is that important? Maybe, maybe not. Last year, we made 518 million in profit. This year, we made more profit. So again, what's going on is in the detail of these numbers, but at least you're able to compare year on year and look for a trend. 2 years, I agree, does not really make a trend. But if you're looking at somebody's income statement, you probably can get 3, 5, 10 years worth of data. So you go ahead and look for that. Okay. So on the balance sheet, again, you've got your total assets are highlighted here because that's one of the items that will show up in our ratio analysis. Remember that our assets are going to equal our liabilities plus owner equity, stockholder equity, just equity, depends on who wrote, who developed, printed the balance sheet. And you'll see that the total liabilities is the same, total liabilities and shareholder equity are the same as the assets for that same calendar year. Total liabilities, current liabilities, stockholder equity, each of these items may be used in a ratio. So again, knowing where to look for retained earnings, knowing that is on a balance sheet as opposed to an income statement becomes important to you. So in the summary on this particular set of books, the assets were the 14 billion, the liabilities 11.8 billion, stockholder equity 2.9 billion, so that assets are balanced by the liabilities and the equity. And that's all seen on the balance sheet in these different locations. We've talked about cash flow. So for example, that net income from our income statement shows up as cash coming in for that fiscal year. The depreciation is a non-charge charge. You're going to write down depreciation on your taxes as if you paid it, but in reality, it's a charge for taxes only, and it will not truly show up as cash out of your bank account. It will be the result of past purchases. So at some point, this company purchased, I don't know, let's guess $30 billion. And every year, $1 billion plus is depreciated, and it reduces their taxable income because it shows as an expense, but a non-cash expense. If you choose to go into accounting, God bless you, but it's not the kind of thing that you're going to handle on a personal level very often. If you own a rental home, you will depreciate it. If you use a car for your business, you might depreciate it, but generally speaking, businesses have these depreciable assets, and all that is taking a portion of the value of that asset each year and saying, well, it's this much older, so it's worth this much less. So we see cash that came in from net income, the cash that truly didn't go out as depreciation, other changes in accounts receivable, liabilities, inventories. Each of these items on a cash flow are impacting this business. The business may have also spent money on new equipment, a new building. So in this case, in 2012, they spent $928 million, and they got money in from other investments. So there's money that came in and money that went out, but still on net, they spent more money than they brought in. It looks like they purchased stock this particular year. So they spent $1.2 billion buying stock back. Most of the time, companies do that with the hopes that the value of the stock goes up because there's fewer shares out there. They borrowed some money, so there's some cash coming in, so their financing activities are less. Each of these become important in managing and evaluating a business. Now we come to our financial ratios, and we'll group them into 5 separate categories. Debt management, ratios that tell us how that company uses debt to finance their business. So a company where people borrowed money to build a business compared to people who took money out of their pocket to build a business, their debt ratio will be different. So if you borrowed 100% of your money versus borrowing 50% or no percent of your money, you'll see those market differences when you look at a balance sheet between the liabilities and the owner equity. So there are 2 debt management ratios that we'll talk about: the debt ratio and the times interest earned ratio. Just trying to see how this company is using borrowed money, how much they're using, etc. The next ratio grouping is liquidity. So we're trying to figure out if a firm, if it has enough assets to cover its liabilities. 2 things we look at is the current ratio and the quick ratio. They're subtly different, and when we get to it, you'll see. For example, what they're doing is saying, do we have enough cash to pay our debt at this time? Or if so, if not, what is the ratio of our assets to liabilities? And that's one way that we can evaluate the health of this company. The next group is in asset management. So these are ratios which let us evaluate how well the firm manages its money. Does it have excessive inventory so that they have money tied up in inventory, or is it managing its inventory so tightly that they buy something today, they sell it tomorrow so they can buy more the next day, and so they have a very quick turnover of inventory. They're buying the right stuff in the right quantities so that they almost never have money tied up in their inventory. It's always working. And it's an estimate of how well a company collects money that is owed to it. So remember, we lend companies product, so they pay us net 30. They buy something today, they pay us in 30 days. So the days sales outstanding ratio is an indicator of how well that company is managing the money that is owed to them. A company that's all cash, nothing ever done on credit, and that isn't to say credit cards, because that is a cash transaction because you get that cash pretty much right away. But if you are lending somebody, if you're not lending anybody goods or services, then your days sales outstanding is 0 because no one owes you money. If all you ever do is sell on credit, then if your terms are net 30, but it takes you 45 days to collect that debt on average, then your day sales outstanding, 45 days, instead of your ideal 30 days, are, it's showing that you are either working with customers who don't have good cash flow and can't pay you right away, or you just are not spending the time it takes to make sure that they pay you instead of somebody else. Total assets turnover, meaning how much did you invest in this company and how much is it generating. A couple of market trend ratios, the price to earnings ratio or the market to book ratio. Both of these are going to require an outside bit of data. So something you would find from the stock market itself. Look at what is the price to earnings ratio. How much are people willing to pay for $1 of earnings? And you'll often see companies in the 5, 10, 20, 50 ratio, meaning people are expecting that if they are owners of this company, as in shareholders, they will earn money in the future. So they're willing to pay a premium today to be a shareholder because they are paying more than what that company is earning today. Market to book ratio, you can look at the total number of shares outstanding. If a company has issued 1 million shares and those shares are trading at $10 a share, there's a $10 million market capitalization. So when you listen and hear companies talk about large cap funds, you're talking about companies with very large market capitalization. So this $10 million market capitalization, when you compare it to the value from the balance sheet, might say that people are paying more than what the company is worth. There's a whole group of investors out there that will look at the market to book ratio, and when it's very low, as in the market is very similar to the value of the company, and there's something positive potentially happening, then buying a company that is on the low side of market to book ratio is appealing to some people. And finally, we look at profitability, things that allow us to see how well people are turning their sales into profit. So profit margin on sales, return on total assets, how much did we invest in this company in the form of assets, and how much is it making for us, and return on common equity. So the assumption here is that common equity is higher when our liabilities are lower, but return on total assets are not going to end up being the same thing. So let's start with these in more detail. So we're going to look at the debt financing and ability to repay debt for, in this case, Safeway, because their debt ratio, the extent of their debt financing, is the ratio of their total debt to total assets. Both of these are found on the balance sheet. So if we skip back to the balance sheet, we saw the total assets, $14.657 million, so $14.6 billion. And then the total liabilities of 11.7 billion. And so we are looking at the debt to assets ratio of 80%. I want to see real quickly if I can keep these two files open at the same time so that I can flip between them. I'm just not positive yet. Almost there, hold on. No, it doesn't appear that I can do that, so we'll have to bounce back and forth. Better luck next time. So as we've looked at the extent of debt financing, Safeway has 80% of their value created through borrowing money. Their total debt is 80% of their total assets. So that means if they had a bad year, they might not go terribly far before they had financial problems. Can you see the PowerPoint right now? Thank you. Times interest earned is a ratio where we're trying to see, can the company actually pay the debt on its interest? You may recall we talked about a time where it might be hard to pay your entire obligation, as in your principal interest, paying back your loan and the interest that is being accrued. So in this case, we're looking at the earnings before interest and taxes and its ability to actually pay the interest. So once again, we have interest being paid of $304 million, and our earnings before interest and taxes, which was just above it, was 1.16 or $1.1 billion. So they were having earnings 3.8 times their interest expense, which should be sufficient to allow this company to survive well. Our next set of ratios are liquidity ratios. We're comparing the assets to liabilities, again, in terms of Safeway. And so when you look back at the slides, you're going to probably want to open the balance sheet and the income statement instead of me jumping back and forth, because I think that'll probably be crazy. But our current ratio is our current assets and our current liabilities. These come from where? Someone must know where current assets and current liabilities comes from.
Is it balance
sheet?
Balance sheet is correct. So you're starting to understand where to look for data. Current assets are those things that are cash or can be turned into cash in the current year. That's just the way it's described. Current liabilities are the debts that we need to pay in the current year. So that allows us to see whether this company is, kind of liquid enough. They have enough cash to move forward. So when you look back at the balance sheet, our current assets were $4.1 billion, and our current liabilities were $4.6 billion. So that kind of looks like we don't have quite enough to close up shop and pay all our bills. We would be short $500 million or so dollars. But the current ratio is just looking at, can the current assets pay that debt if it had to? And it's almost a one-to-one, so it's not horrifying, but that is kind of indicative of a company that used a lot of debt to create itself and to build itself. Remember, our ratio was 80% was debt ratio for this company. The quick ratio is now another look at their ability to pay off current liabilities. But in this case, it's the current assets less the inventories. In many, many companies, the inventories that they use are not necessarily easily used by everybody. So for example, if you were producing a unique paint, you might have to order some very specific chemistry that is expensive to get, but there's such a small market that if you had to sell it today to generate cash, you would have difficulties. So the current assets less the inventories as a ratio compared to the current liabilities is what is called the quick ratio. Quite often, companies that have a lot of inventory, again, if they have to sell it fast, they will take a loss. So they take that out of this equation for the debt ratio. So remember that the current assets minus inventories gets us down at quite a lot lower in terms of how much of their liabilities are they able to pay. So knowing that you can't necessarily sell inventory fast, you're kind of in a worse shape because you have a lot of money tied up in inventory. In the case of Safeway, inventory are bananas and cereal and milk and things like that, some of which will spoil, some of which you would have to sell at a low price if you had to sell it fast. And so you would end up seeing that you will not be able to cover as much of your current liabilities if you had to sell that stuff fast. When we look at how a company manages its assets, we look at something like the inventory turnover ratio, and we try to see, do they buy the right amount, the right frequency, many cases the right materials, so that their sales are good compared to how much money they have tied up in inventory. A company that has $100 million of inventory to do $150 million of sales is not as effective as a company that has $50 million of inventory to do the same $150 million of sales. So we're looking for how well does that company manage their purchases to support their sales. So in Safeway's case, we had the sales for that particular year, $44 billion. Now the average inventory balance, the sales obviously is coming from the income statement, but in this case, the inventory balance is coming from the balance sheet. So you're using two different financial reports in order to figure out the inventory turnover ratio. And it's a simple evaluation of their inventory. What was the inventory at the end of last year? What's the inventory at the end of this year? Add those, divide them by 2, get the average inventory balance. Now, when Safeway is turning inventory 18 times, they're basically buying 3 weeks worth of supplies at a time, selling it, buying more. I mean, they're literally not starting from scratch, but they're buying enough of their materials that turn very fast that they are doing well in terms of their inventory turnover. If you had a very low number, then the way your company is purchasing materials, you may be purchasing a whole bunch of stuff to save a little bit of money, but it sits there forever and ever and ever. And so that your inventory balance, your average inventory balance is high compared to your sales, and your turnover ratio is low compared to your sales. In general, you'd like to not have inventory sitting around not performing, as in not generating sales. So you want to try to keep your inventory balance low and stick to items that will sell quickly. We talked a little bit about this already. Our day sales outstanding ratio is the average time between a sale and a payment. In a business like mine, when I sell on net 30, but I collect on average in 35 or 36, that's not horrifying, because most companies will say, oh, my invoice is due on the 30th of the month. So on the 30th of the month, they may write a check, get it signed the next day or two, and get it sent out. So taking into account things like how long does it take to get the check from there to here will play a part in your average time between sale and payment. Companies will bring that down by offering that 2% net, 2% 10, net 30, so that they're giving people a discount if they pay early, or they have to pay the amount they owe if they pay on time. In all cases, you're expecting your customers to pay on time, but in all reality, your customers, it's up to you to kind of make sure you are asking them to pay you. They will kind of let you slide if somebody else is complaining. So if they send that guy a check and not you, then that's somewhat on you. Asking your customer to pay you on time and reminding them that on time is about now becomes an important part for managing your cash flow. Okay. In the case of the days sales outstanding, again, we're both on the income statement and on the balance sheet, because net receivables, or accounts receivable, depending on how you see it, are $909 million. Their average sales per day was that 44 billion divided by 365. So their average days sales outstanding is 8 days. And that makes sense for Safeway, because most of us are going to go in and pay cash, or with our debit card, or with our credit card. So most of us are paying right then and there. They do have some industrial customers, maybe a hotel, a restaurant, a school, that is ordering and then they pay them later. So it's not a 1 day or 0 day sales outstanding ratio, because they do have this combination of customers that pay me immediately versus pay us over time. They tend toward the pay me immediately side, therefore they have a very short day sales outstanding. When you have a sales force, it's probably important to make this aspect critical to your salesman, and say, you need to bring us customers that are good at paying, pay on time. If you bring me big customers that don't pay on time, it risks the livelihood of the business, because if they can't collect cash, then they can't pay bills, and it's a bad spiral for most companies. When we look at those assets again, the total asset turnover, we're still in the income statement for sales, balance sheet for total assets. We're looking at how much revenue is generated based on the assets the company has. I think one of our videos talked about a business where they had $100 worth of assets and they generated $1,000 worth of revenue, versus one that had $10 worth of assets and presented the same $1,000 worth of sales. And so the total asset turnover is much higher if you only have $10 worth of assets compared to the 100. So sales, again, income statement, 44.2 billion. Total assets from the balance sheet at 14.6 billion. So the total asset turnover is 3 times. For every dollar invested in assets, assets being property, plant, equipment, inventory, cash, for every dollar in there that's inside this company, they're generating $3 worth of sales. Is it good? Is it bad? You'd have to look at other companies of the same ilk to figure out how they compare. But clearly, if you could invest $1 and get 3 back every year, that feels kind of reasonable. When we start looking at profitability, we're going to look at the profit margin on sales at first. So we have net income. How much money did we make at the bottom of the income statement compared to the overall amount of sales that we did? So when we looked at the Safeway income statement, we saw that they made $597 million in that particular year on $44 billion worth of sales. That's showing me 1.4% margin on sales. And, does that seem okay? To me, it seems kind of low. In this case, 1.4% is about the interest you might get if you took all that money and put it in the bank. So in a bank, you have low risk. In this kind of business, you have the risk of food spoiling. You have the risk of customers going to another store, all sorts of things going on. So it doesn't feel particularly appealing when you look at a 1.4% profit margin. When we look now at the return on total assets, we're looking at the income statement, the balance sheet, the same 597 million in income, but now we're looking at 14.6 billion in assets. So the yield for the dollar that you're putting in, you're getting a 4% return on your total assets. That's better than the 1.4% that we look at profit margin on sales, so that we know that we didn't have to put that much money in to generate this 4.1% return on assets year in and year out. Well, at least this year, because it is kind of a target that will change from year to year. Is it good? Is it bad? Once again, you need to compare it to another Safeway-like company. There are lots of companies out there that have much higher return on assets and much higher profit margin on sales. But it would be inappropriate to compare Safeway to Intel, for example. So you're definitely using these ratios when you're comparing investment decisions, when you're making investment decisions. You are comparing like companies with these ratios, not dissimilar companies with these ratios. So our return on common equity is now a function of how much money was generated, that net income, 597 billion or million again, and the average shareholder equity, the average common equity in this company. I don't mean if you take all the investors, what's their average investment? We're looking at the investment of last year on the balance sheet to the investment on this year in the balance sheet, because you're going to have changes. Companies will potentially buy stock back. Companies will issue more shares. The value in the shareholder equity section will change depending on your assets and liabilities. So in this case, the average common equity, or the average equity, now shows us that for an individual shareholder, the return is 18%. So if I am buying stock in this company and it's returning 18% toward my investment, now I'm starting to think, maybe this is a good investment because it's performing better than the historical average of, say, the Dow Industrial Averages or the stock market, which probably averages 12% over its history. It looks like heck right now, but generally speaking, it's going to be at that 12% increase historically. When we look at the ratios comparing stock price to operating results, you're looking at that price to earnings ratio. How much is the price per share? What is the market value per share? Something that you have to get any moment of any day from the stock market. And how much did that share earn? So what investment is required to create $1 in current earnings? So in this case, the price per share on December 29th, 2012 was $17.70. You can look that up. You can go find out what today's price is, whatever you need. But the earnings, the 597 million and the 246 million shares. Now you've got a price per share, earnings per share, and the PE ratio is 7.3. So that means that people are buying shares of Safeway at the time, and they're paying this premium, 7.3 premium for purchasing those shares. They're paying more than those shares are giving back to them in that particular year. I mean, the only reason you would do that is because you think that something is about to happen. You expect it to do better than that in the future, things of that nature. You're looking at the trends in food, grocery stores, etc., and you see something going right for them. The market to book ratio is the assessment of what investors will pay for the return on their investment. So the price per share, that's $17.70, versus the book value per share, which is solely the data on the balance sheet. We figure out what are their assets minus their liabilities, what is the value of each individual share, and we see that the market to book ratio, people are paying 1.5 times more for a share than that share would be worth if you dissolve the company. Obviously, people are looking at this and saying, it's going to get, earn more on, therefore I'm willing to pay more than its book value, because book value doesn't take into account the trends in sales and whatnot. So the price per share will often be associated with what's going on in the market, whereas the book value per share is just that snapshot on what that company is worth on that particular day. So if we were to do something like compare Safeway and Whole Foods, or if you're not familiar, Whole Foods is the company that Amazon purchased. And you could see that in that same basic time frame, Whole Foods fiscal year ends in September, Safeway's fiscal year ends in December. So there's a little bit of timing difference, but the price to earnings, Whole Foods was generating, the price of their shares compared to their earnings was pretty much twice what Safeway's was. Their market to book, as in what people are paying for the book value of the company, was again a little more than twice what people who owned Safeway were willing to pay. Right. In the debt ratio side, Safeway had a very high debt ratio, 80%, but Whole Foods grew up a little more organically with money that they had. And so they had a much lower debt ratio, much less likely to have problems in a situation where they were having problems with sales. The times interest earned relative Safeway to Whole Foods, because Whole Foods managed their growth differently, they weren't able to look at it. So you know that either they have no debt or they have no long-term debt that makes that negligible in the debt ratio market for times interest earned for Whole Foods. From a liquidity standpoint, their current ratio is 2+ times better than Safeway's, Whole Food to Safeway. And their quick ratio is a lot better, 5 times better at Whole Foods than Safeway. So these are allowing us to compare Safeway to Whole Foods to decide if we're going to invest, which of these two companies side by side would we choose. Asset management, Whole Foods is almost double. So where Safeway was buying stuff every 3 weeks, Whole Foods is only holding about a week and a half's worth of goods. So their inventory turnover is better. Does that mean they have less spoilage? Maybe. But it does mean that people are buying faster those items that they are offering. And it could be that Safeway is just much better at their supply chain so that they get a little bit in all the time and spread that investment a little differently. Safeway, Whole Foods, about the same on day sales outstanding. Both of them are doing the bulk of their sales cash basis. And the total asset turnover, you see that Safeway has a little bit better asset turnover than Whole Foods does. But so far, all in all, Whole Foods it's looking like a better target to invest in. Profitability, profit margin on sales. Again, Safeway 3 times better than, Whole Foods 3 times better than Safeway. Twice as good on their return on total assets. The return on common equity, not as good, but that could be a function of the total amount of shares. Whole Foods might have more shareholders, therefore it's spread out a little differently. It doesn't make it bad in this case, but it definitely bears understanding. In all cases, when we look at these side by side, now we can start to paint a picture of the health of the company, how well it's managed, how well they're using their money. Well, in this case, if you are an investor, how well are they using your money to generate income? And what we find is that the value of a company is mostly tied to the expected future profits of that company. Whole Foods had a brighter future at that time, and it turned out to be, in fact, the case when Amazon announced they purchased them and really pumped a lot of money and created a whole new distribution channel through Whole Foods. I suspect if we could look at their financials now, it's embedded now in Amazon's books to the point where it would be difficult. But if we were to look at Whole Foods now, we'd probably see many of those ratios going up, doing better relative to Safeway. Okay, so the question came up, are we allowed to use an equation sheet for the final? Generally speaking, I don't use those kind of sheets. There aren't that many here, and they're all very logical. If you look at the name of it, you should be able to back into what's going on. There are a total of 15, most of which are going to be easy to say. Do you really need, for example, a cheat sheet that says what's price to earnings ratio, what's market to book ratio? No, I find that you probably don't. When you understand the balance sheet and understand that the current ratio includes all assets and the quick ratio takes out inventory, you're going to be able to remember those things. So it is not my plan to facilitate cheat sheets. I know that's a little bit different for me in the form of lockdown browsers and what is going to happen. Honestly, I would prefer you didn't use one. It will get flagged through the system, and therefore, it probably will be noticed. So please plan on not using them. I will find a way to make sure that the lockdown browser allows you to use the calculator on that screen so that you'll be able to do these ratios to find the answers that you need. In the scheme of things, there's no hard math here. So generally, I would have told you to bring a calculator. I'm not sure how the system that looks at your behavior while taking a test will look at that. But if I put it on, if I make it so that the general calculator or the scientific calculator are available in the lockdown browser, then you have no issues with that at all. Are there other questions for today? Well, seeing none, we'll have our wrap-up session on Wednesday on due diligence, trying to put all this information into a practical application. And we will see you on Wednesday. Stay safe and have a great week.